So we are coming to you live here to educate you on some market insights, 2025, what that means for the world as a whole, for, portfolios and some of our thoughts around that. For clients, you're going to hear some things that you may typically hear during our review meetings. It's going to be a much more expanded version of that discussion as we look to, expound upon some thoughts that we have for what's going on overall into the economy. So without further ado, I'm going to share my slides here for the 2025 Market Insights Building a Resilient Investment Strategy. First off, a disclosure. So informational, educational purposes only. Obviously, there's risk in investments. If you're going to make any decisions, please consult a qualified financial professional before doing so just on this webinar. Now, 2024, before we go into 2025, let's take a brief look at what happened in 2024, and there was a lot. But long story short, at the end of the day, the S&P 500 did something that it hasn't done since the 1990s, and that was complete 2 consecutive years of 20% plus performance. So 2024, 2023 were both 20% plus performance for the S&P 500 for the first time since the 1990s. So very, very good performance in back-to-back years. That is despite all of the different news that was out there. And you see some of the different, clips, some good, some bad, some neutral, like Oppenheimer winning the best picture. Not sure why that would affect the markets, but hey, it happened in 2024. Congratulations to Oppenheimer. But when we look at all of the different things, we can get caught up in the noise. And so I want to rewind a little bit even further than 2024 to take a look at what professionals were saying about the markets at that time. So you had Yahoo Finance back in 2022, right? No doubt about it. Bloomberg economists now see a 100% chance of a recession within 1 year. Now, last time I checked, 100% means that it would definitely happen without any hesitation, any chance, not 99.9, 100% chance. And as we know, it didn't happen. Then June 2023, USA Today comes out, recession or no recession. Deutsche Bank, economic downturn, 100% inevitable. So much certainty there. That didn't happen. And then again, 2024, 85% chance of a recession. Highest probability since the great financial crisis, except they just had a 100% chance from Yahoo Finance experts in 2022 that didn't actually happen. So there's just confusion out there. So thanks for Andy Baxley for putting this together. I saw him post this graphic and asked if I could use it. So in light of all of that, what actually did happen? And this is our GDP, and this is how we measure here within the US our growth of our economy. David, why don't you kind of take a look at the history of our GDP, because we did take a little dip there in 2022. There was some concerns, but what happened with our GDP over that time?
Well, GDP has remained strong, other than in 2022 where things were off. And of course, we saw that the financial markets were off in 2022 as well. You'll remember 2022 was the period where inflation peaked. The consumer price index went over 9% in 2022. We saw a rapid rise of interest rates driven by the Fed initially raising Fed funds rate, but also by the investment marketplace. But if you go beyond that period of 2022, what you do see is a pretty strong GDP growth. And what this is telling us is that now we've had 20 consecutive months where wages have outpaced the consumer price index. So people are making more money than inflation is eroding. And because of the advances in the financial markets, we saw in 2024 an increase in real wealth, household wealth by 11%, or an increase in household wealth of $15 trillion. So that's money that people are going to be spending.
Yeah, for sure. Yep. And you talked about the wage growth here, and that's what this slide is showing alongside of unemployment, which has also stayed, very low. Obviously, we had that huge spike that you see there in 2020 due to COVID, But since then, as people were getting back to work, we had a very, very low level of unemployment that has been starting to creep up, but still considered, at that, full employment level, way below our 50-year average of 6.2 from an unemployment rate. And then the wage growth, as David was saying, has been slowing, but still has been able to outpace inflation there, which is all of this is very, very good news for the overall economy.
Now, the
Now,
trick is going to be, I'm sorry, Justin,
yep,
but the trick on the employment issue is going to be that there's been a huge influx of immigrants, both through legal channels and non-legal channels. And all those people are going to have to find work. Right now, the economy is strong enough to create jobs for all of them. In fact, we need all those workers. But the trick will be going forward if we're able to keep at a full employment as we are right now.
yep, very true. David did touch on the inflation, and there's this chart showing it back in 2022, June, 9.1% reading, very, very high. But the good news here from this slide is that inflation is moderating, coming under control, much closer to that Fed target of 2%. Now, one thing we want to be careful here, the rate of inflation is slowing, but at the end of the day, it's still inflation. And so those prices that were baked in now that increased by 9% are still increasing. So it's not like you're going to see prices magically come down as they say inflation is lowering, which is true. Inflation is tending, as you can see from this chart, to fall, but it's not deflation. So the prices that we had are still sticking, and we just need to control the increase further so that we can let our income, let our wage growth catch up so that we can pay those higher prices.
Yeah, in fact, what I like about that chart too, Justin, sorry, I got to move a little quicker, I guess, is it gives us a longer time period. So you can see where inflation was prior to early 2021. And you can see why the Federal Reserve is so insistent on getting down to that 2% level versus the 2.7 that we're at right now.
Yeah. Now, the markets as a whole, and we can look at the S&P 500, we started off, with the statistic from 2023, 2024, very, very good performance in back-to-back years, but that technically comes at a cost because yes, earnings are but investors right now are willing to pay a relatively high price, at least if you look historically speaking, for those earnings. And you can see from this chart with a 30-year average of the S&P 500 at 16.9 times, where the current as of the end of 2024 at 21.5 times, so considerably above that. Now, any time when we're looking at something like a valuation measure, like the forward-looking price to earnings ratio, we always have to be careful because it really doesn't tell us anything in the short term. And you can see, going back to even 2021, which ended up being a very, very good year, it was at a very, very similar level. 2022, it dipped down a little bit with the reduction. 2023, it was back up, and now it's even higher ending 2024. So over shorter time periods, it doesn't really tell us much, but over longer time periods, what the expectation should be if you're only investing in the S&P 500, or that your returns should be lower because you're paying a higher price. Now, I'm not saying it's going to be a crash or it's going to be a huge downturn, but I am saying your longer term expectations over the next 5 to 10 years should be lower than what we've experienced over the previous 5 to 10 years. David, anything to add about this slide?
No, I think it takes us nicely into the next slide as we move forward. And to Justin's point, we all know as investors, the best time to buy a stock is when the price is low. Right now, from that last chart, we saw that prices are relatively high compared to historic numbers. And the way we measure that oftentimes is through a statistic called price to earnings ratio, how much a person is willing to pay for $1 of profit. And when Justin gives you the figure of over 20 times being historically high, you can see on this chart why that becomes so important. When the price to earning ratio gets high, the expected rate of return becomes low. And the way you can think about that is, again, the idea is that I want to buy something at a low price, let it go high. If I buy something at a high price, what am I hoping for? I'm hoping for it to go higher. But at some point in time, the music stops and it's got to come the other way.
Yep, exactly. And this kind of shows you, though, over the longer term on the right side. So that's a 5-year annualized return. But you can see over the left side, we can't really use this for shorter term predictions, because if you look at all of these dots right here above to the right of this big arrow showing where we are currently in the price to earnings ratio, those were all instances where the price to earnings ratio was higher than we are now, and yet the rates of return were very, very good from the S&P 500 in that year. So it doesn't mean that this year, obviously, we could get some negative returns. That's happened in the past too, but this is too wide of a dispersion to say, just based on the price to earnings ratio, the S&P 500 will do X this year. But as you extend that time frame, you can see the dots getting closer and closer to the line, meaning that we're getting much more within a expected range. And so we kind of are more assured. Now, it could fall outside this range. There's no guarantees here, but the expectation, generally speaking, should be a lower rate of return the higher you pay from a price to earnings perspective. But what's also potentially concerning about the S&P 500, not just the price to earnings, the concentration risk in there that we've never seen before in the past. And so currently, as of the end of 2024, if you take the top 10 stocks in the S&P 500, they make up over 38% of the holdings. So you have 500 companies, just 10 of them make up well over a third of the index, and then you have the 490 left to fill in the gaps. And you can see in history, we've never even been close to this, and it's continuing to exacerbate that potential issue. And David, why would that be a potential issue?
Well, it's a potential issue because so much of your money is invested in just a few companies. So understand the way the S&P 500 is constituted. Each of the 500 companies are given a weight based on the company size. And what we've seen over the last couple of years is the bigger companies are getting even bigger. And not only that, when you look on the left-hand chart, you'll see that not only are they getting bigger, but people are paying more for them. So when you look at that green line, where's it going? It's shooting to the moon. Well, when we look back on the Great Recession of 2008, when we look back on the tech wreck that was the dot-com bubble bursting in 2001, we look back now, we look at the statistics and go, oh, how didn't everyone see this? It's so obvious. I'm not predicting that there's going to be a big calamity down the road, but at some point in time, we're going to look at it and say, why would we pay so much for stocks? And I'll give you an analogy. On the top of the left-hand side, you see a chart and says the top 10 currently selling at 29.8 times earnings versus its historic average. In other words, people are paying 45% more for those top 10 companies. And you know what those companies are. They're listed on the bottom. It's the companies like Apple and NVIDIA and Microsoft and Amazon, et cetera. Why would people pay 45% more for anything than the historic average? And you can think if a neighbor sold their house to somebody who paid 45% more than the average price for homes in your neighborhood, you'd probably laugh and go, that guy is never getting his money back. Well, think about that when you're buying into the S&P 500. So the reason this is such a concern, to answer your question, Justin, I gave you a very long answer, is that there's a lot of people who follow the S&P 500 like it's an investment. And it was never designed to be an investment. S&P, Standards & Poor's, created this index to just show us how the typical U.S. company is performing. And because of that, the S&P 500 has performed well as an investment, and a lot of people follow it as an investment. A lot of money in retirement accounts at work are tracking this S&P 500. There is a word of caution there for where it's headed.
And whenever things are doing well, the investment community, the news media, the outlets, they like to put fancy names on things. And so we've had the Magnificent Seven that kind of dominated last year. We had FANG going back a little whiles, when the tech was booming. But now we have a new name, and I thought it was quite fun to share because we got a new trillion-dollar company, some good growth happening there, and we have the new acronym of Batman. So you can see on the screen there, Broadcom is that new trillion-dollar company that's added to the list, doing quite well, along with Apple, Tesla, Microsoft, Meta, Amazon, Alphabet, and NVIDIA, Alphabet being Google. And so those are now dominating. And so they've got this fun new name of the Batman stocks. Not that you could use this in any meaningful way, but I thought it was fun to share. But what you can use in a meaningful way is our takeaway number one that you can take home to the bank is diversifying beyond just large US companies. Because although things like the S&P 500 are trading at a relatively high price to earnings, you still have smaller companies, even within the US and internationally, that are trading at lower price to earnings. You've got international companies in general, both on the emerging market side and the developed side, that are trading at lower price to earnings. So not focusing all your eggs in one US basket that's getting slowly more concentrated in only a handful of stocks. We want to have protections, and we don't want to be so reliant on one asset class or one stock to generate our returns for the future. And that's why we need to diversify beyond just those large US companies. David, why don't you talk about another risk here in terms of tariffs?
This is a fun subject. Okay, so tariffs. So there may be some people on the call who haven't heard that President-elect Trump is a big fan of using tariffs. Now, probably no one is not aware of that. On the far right-hand side of this chart, you can see on the campaign trail the threats that President-elect Trump has made for raising tariffs. So this is a combination of all those threats that he's made. And you can see where that would take us. It would take us back to the early parts of the Depression. We got so used to saying recession, but there was once a depression. And it's not likely that we're ever going to see the level of tariffs that have been threatened. It's a bargaining tool. It's a lot of rhetoric. Will there be increased tariffs? I think it's a certainty that there'll be some increased tariffs, but probably not to the extent that we have feared.
But where does that leave us from a federal finances perspective? Because right now, tariffs make up only 1%. So it's not really for an income generation piece. I think you said more of a bargaining tool that Trump was going to be utilizing. But we still need to generate money from somewhere. Would tariffs help with that?
Well, look, it can't hurt. I mean, any revenue that's generated will help. If you look at the chart on the left, what you can see is in fiscal year 2025, Congress is expecting to spend about $7 trillion with a T, $7 trillion. $2 trillion of it is going to come from somewhere other than revenues raised. So they're collecting about $5 trillion, spending about $7 trillion. Anyone see a problem with that? Sure, big problem. So where's that money going to come from? Well, obviously we're going to borrow whatever we can, whatever we have to. But if you look at the stacked bar on the left-hand side, try and figure out, if you were in charge, where would you cut the $2 trillion that you need to balance the budget? Well, you don't have any control about net interest, because that's what the bonds you have to pay in interest for the money you've already borrowed. Anybody think it's politically wise to cut back on Social Security? That sounds like a one-term House of Representative member. Medicare, same thing there. Medicaid, there maybe politically you could be able to cut it back, but you still have the problem people need to get their health care. The gray box of other mandatory spending, the key word there's mandatory, so you can't change that. Defense spending and non-defense discretionary, those two categories are essentially where the debate begins on where you're going to cut from. But if you add those two up in their entirety, they're not as big as the deficit that we're running. So the DOGE, the Department of Government Efficiency that has been created, is going to look to cut some of this spending. But in all likelihood, we're not going to get to where we need to just by cutting spending.
Yeah. And then you can see this is 2025, but it could even get worse, because now with the Republicans in House, we do expect them to pass an extension of the Tax Cuts and Jobs Act that was supposed to sunset at the end of this year. And you can see on the right side how, if we do pass that extension, that the deficit continues to increase. And you look at the net debt continuing to increase at an even faster rate than was initially expected with the Tax Cuts and Jobs Act sunsetting. So we're not doing it on the spending side, and then we're bringing in less tax revenue, because Tax Cuts and Jobs Act in general lower taxes, rather than letting them that law sunset and go back to higher taxes. If we extend it, we're not bringing in that additional revenue there. So something needs to happen here somewhere. And all along the way, you have the Fed and interest rates. And there was wide expectations that interest rates would fall, and the Federal Reserve did take this federal funds rate and reduce it by a full percentage point back in 2024. The expectation for this year that they've set is 2 additional cuts for this year, which is reduced from what they initially were expecting. But what's very, very interesting is that although the short-term rate, which is what this is, was falling, at the same time, the 10-year rate, the 10-year Treasury, has been rising. And that has risen to actually its highest level in over 17 years at this point, even with the shorter-term interest rates falling. A lot of that has to do with some additional fears around inflation, with what the tariffs could do to that. And so the interest rates, which we initially were expecting to come down, haven't really done that. They've stayed elevated. And so if they stay elevated or even continue to creep up as they have been unexpectedly, that could have some ramifications for your bond portfolio.
Yeah, and the thing to keep in mind, Justin, is if you listen to the press, you could be led into belief that the government and the Federal Reserve have complete control over the financial markets. I mean, how often do we hear the Fed is cutting interest rates? No, they're not. The Fed is cutting the Fed fund rate, which is the rate that large money-centered banks can borrow money on short-term basis. That's not the rate that I'm paying. And back in September, when the Fed cut rates for the first time, there was a lot of people who were shocked because they were looking to buy a house and they're waiting for mortgage rates to come down. And what happened when the Fed cut rates? Mortgage rates went up because investors said, yeah, the Fed's cutting rates for the short term, but I'm not optimistic for lower rates in the long term.
Yep, no, absolutely. And that leads us to our takeaway number 2 from an investment management perspective, because the primary reasons that we believe that someone should hold bonds in their portfolio is to help decrease volatility, increase that safety and security. And so because of that, we want to keep the fixed income shorter term, higher quality than the broad bond market, because we could still see volatility like we did in the longer term treasuries in 2024, where most things were up last year, and not long-term treasuries. They were actually down because of the unexpected maintenance of the higher interest rate. And so you want to be careful in your bond portfolio, because if we do have that unexpected increase, you could see some massive volatility in those longer term bonds that you wouldn't see in the shorter term bonds. Now expanding out further from the US and looking more so at the global markets, one of the things that we'll see in the chart on the top right is that as those US companies continue to get bigger and bigger, they continue to become a larger and larger piece of the global market as a whole. And as of right now, the US is sitting at around 67% of the global market cap, dwarfing any other nation. The next highest single nation is actually Japan at 5%. And then we've got groups of stocks shown here from the emerging markets at 10%, and then Europe minus the UK at 10% as well. And so what is the story here? Well, the story here is that international diversification can still work. And just like we don't want to follow the trends of the handful of companies in the US that are getting more and more concentrated, we don't necessarily want to all flow into the US, especially as the price to earnings ratio maintains higher. Now, there's some arguments here for US companies being global in their nature anyway, providing some type of diversification there, because not all their revenues obviously are tied up in the US and they've got their footprint globally. But still, just because a company is located in Germany, does that mean you should automatically want to exclude it from your portfolio? And so we believe there's still great companies overseas. Definitely from a performance perspective, the S&P 500 has dominated those international other stocks and indexes. But just because it's done that in the recent past, we can't invest in the past. We can only invest in the future. And therefore, our decision is to maintain that diversification, maintain those lower prices, even despite of the U.S. becoming more and more of a dominant growth player. Anything to
That's
add around that, David?
Yep. So on one of the earlier slides, we were talking about how the bigger companies within the S&P 500 are getting even bigger, creating more risk. Here, the same thing can be said about U.S. companies on the global stage. As the U.S. becomes a bigger part of the global stage, there's that same type of risk where the old expression used to be when General Motors sneezed, the rest of the world would get a cold. Now, if the U.S. economy has a setback, it could prove detrimental to the entire global economy. But that being said, our next two slides are going to talk about opportunities investing globally.
Yep.
So go ahead.
You take the dollar.
Okay. So the first one we're going to talk about is the strength of the US dollar. And you can see on the chart on the left that the US dollar is stronger now than it has been in a long time. Yes, it's been stronger for a little bit in 2022, and we know how the financial markets reacted then. But what happens is when the dollar gets strong compared to foreign currencies, there's a number of issues that come about. One is it's much more expensive for US manufacturers and US service providers to do business on a global stage. And for that reason, one of President-elect Trump's primary economic uh, uh, challenges, one of the things that he stated that he wants to do is to weaken the US dollar relative to foreign currencies. Sounds kind of odd that a goal of the US president would be to weaken the US dollar, but it helps us to do business overseas. It also helps foreign countries because with so much of the world's currencies and exchanges being based in US dollars, as the US dollar gets stronger and stronger, it becomes more and more expensive for those countries to do business. And what we're seeing is, and you probably have read about this in the news, smaller emerging market countries are beginning to talk about moving away from pegging their currency to the US dollar and using something like a cryptocurrency. That weakens the US control on a global stage. If it weren't for the fact that the US dollar is the primary measure for international business, we wouldn't be able to do things like sanction Russia or China when we want to take make a political statement.
And then on top of that, so then, a weakening US dollar also would boost international returns, because keep in mind that those companies located internationally are on, pegged to their local currencies like the euro, the yen, et cetera. And so if the dollar weakens to those currencies, we could see an increase in the price of that stock relative to the US dollar, even if the price of the stock doesn't change. And so a weakening US dollar actually will help international performance. Another thing of why we like international right now, and what we've talked about, is that discount of the price to earnings ratio. And you can kind of see it here visually on the left side, where it's been trending, continually down. Now, I don't think it makes sense for this chart to go continually down all the way to the right until, international stocks are worth nothing. And so there has to be some type of, average here, or, leveling out. Whether we're at a new normal is yet to be seen. But what I do know is that in the S&P 500 right now, trading at 21.5 times relative to 13.3 times, if there's some type of fear that comes into the market that causes these multiples to be cut, it's going to cut from the higher multiples first before it cuts from the lower multiples, in theory. And so you can see the international markets being at 13.3 times versus their 20-year average 13.1. So pretty much in line with what we would expect from those valuations internationally, where the US is the one that's very, very rich right now from a valuation perspective. And so with that, we don't want to abandon international stocks at this time where the price is relatively low compared to the US. And you can see, even if you break it down by sectors, the current discount is more so now than any time on the 20-year average. And so the takeaway shouldn't be a surprise here. Number 3 is to maintain exposure to international companies within your portfolio. Don't shy away from the recent underperformance relative to the US, because that will happen in diversified asset classes. You won't always get the best rates of return. But holding that diversification, lower valuation, potential weakening of the US dollar, we think there's a lot of reasons to maintain that international exposure.
Yeah, just to restate that another way, the previous slide showed that U.S. stocks were selling at foreign stocks were selling at a 21% discount relative to U.S. stocks compared to their history. 21% discount, and you have a U.S. president who says his goal will be to improve currency exchange rates in favor of foreign stocks. Sounds like an opportunity to me.
Yep. All right, why don't you talk about now the diversification overall? What are we looking at here on this chart?
Sure. So this we nickname our Skittles chart, and we call it a Skittles chart because it looks like someone opened up a bag of Skittles and spilled it out on a table. But what it really is a chart that shows us historic performance over the last, going back to 2010, so it's at the last 14 years, where each color represents a different type of investment asset class. So if we go to 2024, we see the top performing asset class was large cap stocks, U.S. large cap stocks. The one below that, the orange, are small company U.S. stocks, et cetera. Now, most investors, most amateur investors, what they're going to do before deciding how to allocate their money is they're going to look historically and see what's done the best. So here we have it, 14 years of return. Where should you invest your money? You could say large cap stocks because they've done the best over the last 2 years, unless you go back to 2022 where you're looking at a minus 18%. Maybe you prefer to get in commodities because in 2022 they were up 16% when everything else was down. Oh wait, the next year they were the worst performing asset. So it's really hard. In fact, let's rephrase it. It's impossible to look back to determine future returns, and that's why the government makes us say past performance is no guarantee of future results. But what you can see is right down the middle there, a diversified asset allocation strategy is never at the bottom, may not ever be at the top, but it proves to be a pretty good return. And if you look at the numbers, probably be willing to accept almost all those numbers. I mean, the worst number I see here is in 2022 at minus 13.9%. That's not great, but all the other numbers look pretty good to me. So that's a good thing to keep in mind. The other thing I'll just mention here, Justin, is in looking at the big results that we saw for 2024, don't forget, we're looking at things in total for the year. It's still a bumpy ride. In July and August, we had a pullback in the stock market of 8.5%. In December, we had a pullback of a couple percent. I know we got a couple calls of people concerned about the market being down. It was only a few months ago, it was down 3 times as much.
Yeah, it's easier to keep things in perspective when you're looking at history and looking at broad returns. But if you're looking, so close on the day to day and you're seeing that volatility, it gets much more disconcerting there when you see things go down. But what's interesting is when you have that asset allocation portfolio, and even if you start off, let's say, on a, we just use a 60-40 portfolio kind of cut here between half U.S. growth, half U.S. value, about 10% international, and then 40% fixed income, kind of just showing a generic 60-40. And let's say you do start off that way, and then you just let it ride. Well, what this chart is showing that over the past several years, if you look currently, what you would have found, because U.S. large and more so growth companies have outperformed everything, that allocation to them has gotten larger and larger over time. So currently you're sitting at 37% versus the initial allocation of 25%. Value, U.S. values up slightly, international is down slightly, and fixed income is way down from 40 to 27% because that has been underperforming over the last several years. And so what has happened if you're not looking at the portfolio and looking to rebalance is that it's drifting. And so that's going to give, in this scenario, more risk to the portfolio, not only because you're getting more concentrated in a certain asset class, but that asset class has done well. The prices are relatively high in that asset class. So now is actually a good time to rebalance the portfolio, take from those winners, buy those losers, get the risk back to where you want it to be. So if we do see something in the markets that are unfavorable, we at least have the protection of the fixed income in there. Whereas if you didn't rebalance, you have less of that protection. And so being ahead, rebalancing, looking to keep the risk. Now, keep in mind, rebalancing won't necessarily give you a better rate of return. That's not what rebalancing is made to do, because if US growth stocks continue to dominate, then you wouldn't want to have to sold them off to buy something that wasn't going to do as good. But the problem is we don't know what they're going to do. And so because we're managing towards risk and not necessarily trying to get the, ultimate highest rate of return possible, regardless of risk, that's why rebalancing is so critical. Anything else to add here, David?
The one thing I will throw out on this one is if you listen to call-in shows, if you watch TV and hear all the pundits, what do they always talk about? They get you talking about inflation, they're talking about elections, they're talking about all the types of things that you have no control over. Well, here's one you have total control over. Why would you take advantage of it?
Yeah, absolutely. And that's our takeaway. Number 4, rebalancing that portfolio, maintaining desired risk. All right, now the final, leading up to our final 5th takeaway here, we're going to talk a little bit about that diversification still, because when people think of diversification, they typically think of stocks and bonds as like the ultimate in terms of diversification. And then within stocks, we've got, large stocks, small stocks, growth stocks, value stocks, international stocks. So there's kind of diversification within stocks. Then bonds, you've got high yield bonds, aka junk bonds. You have high quality, you have shorter term, intermediate term, longer term. So there's diversification in pieces and pockets, but the broad majority is stocks and bonds. However, what we've seen, interestingly enough, over the last couple of years is that the correlations, meaning the times that they move together, stocks and bonds, have been increasing. And whenever you have correlation increasing, that's going to give you a lower diversification. That's what we're seeing from this chart. Now, 2024, it definitely was not as aligned, still somewhat aligned, but not as aligned because some of those longer term treasuries, as an example, were actually down. But we would still expect this chart to be relatively high. And you can see in history that it could stay relatively elevated. And if that maintains the case, we don't know if it will be. We could be restored back to no or negative correlations in the stock and bond markets in general over the next couple of years, but we don't know that. And because we don't know that, why not take the next step and diversify your portfolio even further if you have the opportunity to do so? David, you want to talk about kind of alternatives as a whole?
Sure, sure. So if we look on the far right side of this chart, you'll see that green and blue hashed circle, which is, again, our hypothetical 60-40 portfolio made up of 60% stocks, 40% bonds. And you'll see on the horizontal axis of the chart, you can see that the correlation or the similarity in the movement is at 1.0, meaning that your portfolio is going to move exactly the same as the portfolio. In other words, that's our definition here. On the vertical axis, we have our 10-year annualized return. So the higher up on this chart we go, the bigger the return. Well, what this is showing us is that all these different types of alternatives take away from the correlation of the 60-40 portfolio. In other words, they take away that similar movement. And what we're trying to do is create a portfolio. Obviously, on the way up, we'd want to have the one asset that's growing the most. But what we're concerned about is being overexposed to the one asset that declines the most. And by putting alternatives into a portfolio, you reduce that risk of having all your eggs in that stock/bond basket that's now moving in tandem with each other. So you can see that these different alternatives perform that function, and some of them improve the performance. Where you look at venture capital and private equity, have a higher expected rate of return than ours is our 60-40 portfolio. So we've been looking to move our clients. We've been moving our clients more and more into this alternative space as a way to protect on the downside and to also add opportunity on the upside.
Yep. And the alternative space is tricky because because they're not readily available and tradable most of the time, like US stocks are, like bonds are, you tend to add an extra layer of cost, extra layer of complexity there. And so they're not necessarily right in every situation, but we do believe having something non-correlated to your stock and bond portfolio, even if it's something like a fixed annuity where we can guarantee a specific rate of return over a period of time as an alternative to the fixed income side, we think that is going to be good for the portfolio overall because of that diversification. So really that's the key throughout everything that we've said is nothing new here, but it's just acting on it and maintaining that allocation, rebalancing, doing all the things that you're supposed to do to have a successful portfolio. So that's our fifth and final takeaway, to consider the alternative investments if that's going to allow you to increase diversification. So David, any final as we look to wrap it up? And if you guys have questions about anything that we talked about today, feel free to drop them into the Q&A. We will be, having a discussion here. But David, what are your finals?
Well, my finals is that we went through a lot of charts and a lot of numbers and a lot of complexities. Right now, what's on your screen is what you got to take away. You got to take away the takeaways. But what you got to pay attention to are these things, because these are the things that you can control. You can't control how the stock market's going to do. You can't control where interest rates are going to go or inflation, but you can control whether you're diversified beyond large U.S. companies. You can control the maturity and the quality of the bonds that you're investing in, and so forth.
Awesome. So I'm just going to stop my screen share so I can open up the Q&A to see if anybody has questions. All right. We got a question coming in. Is there a potential that Congress will extend the tax cuts, but alter it in a way that will be even more expensive? David, do you want to take that?
Sure. Did you pay attention to the campaign where President-elect Trump promised that Social Security benefits were going to be tax-free, or that there'd be no taxes on overtime, or any of the other promises of giveaways? Have you heard that high tax states like New Jersey, Illinois, Connecticut, New York, California want to increase the limitation on state and local tax? Yeah, there's lots of ideas where we can spend more money.
Yeah, going in the opposite direction. And so that's where, when you start to think about those campaign promises, like eliminating the taxes on Social Security, and you look at the chart where we just saw 7 trillion of spending, 5 trillion of income, a $2 trillion gap, where is it going to come from? So, okay, you can cut it now. You can have no tax on tips. You can lower taxes even further by removing the state and local tax cap. But where does it end? And so that's where they really got to look to assess what is going to be most appealing to the economy as a whole. Because if the GDP can continue to grow well, it's still not growing fast enough to outpace our spending, so that's a whole issue. But if the GDP can at least keep pace or grow well, and we have a stimulated economy, it helps things. But if we get to a point where we start to have that GDP and economy slow, and we're still spending tons and tons of money, and we don't have the pockets that we had back in starting in 2007 to get us out of the Great Recession, then 2020, and even further stimulus spending to get us out of that, we're running out of our pockets. And so we just need to be very, very careful, especially in good economic times, that we don't have excess spending. And it doesn't seem that is any concern to anyone in Congress.
And Justin, just to expand further on that, it doesn't have to be a tax law that's going to do this. President Biden just signed last week the Social Security Fairness Act. Sounds pretty good, right? Except for it means more benefits coming out of Social Security. Where that money going to come from? We don't know. Forgiving student loans. Okay, that's going to reduce the amount of money coming into the government to pay back those loans. Where's that money going to come from? Don't know. So it's not necessarily a tax act that could make things worse. It's a lot of what Congress, and let's face it, Congress spends money for everything from defense to medicine to pandemic relief and disaster relief. Politically, I have not heard any congressman or senator come up with an idea that's going to bring us anything close to a balanced budget.
Yeah. All right. We have another question coming in on an asset class we didn't necessarily talk about, so I'm happy to take this question. And they're talking about physical gold. So they've got physical gold they bought, they've saved it over the years. Is it still a good protection against inflation? And so there's a couple different ways we can answer that. But gold, if you look at obviously the recent performance over the past couple of years has been very, very good. um, Gold as an asset class in and of itself, and the reason we didn't necessarily talk about it is we would consider that in the alternatives category. However, within the alternatives category, one thing that you need to pay attention to is the risk, and we would define that as volatility, so how much it's going to bounce around, and the expected long-term rate of return. And for an asset class like gold, if you look at it throughout all of history, it has a relatively high volatility, meaning it's going to bounce around almost like a stock would, except compared to a stock, it has a relatively low rate of return that does, over the very long term, keep up with inflation. Now, over the shorter term, gold isn't necessarily going to keep up with inflation dollar for dollar. And we saw this back in 2022, where inflation peaked at 9.1% and gold was down in that year. And so it's not a direct protection against inflation over the short term. Over the very, very long term, it has proven to keep up with inflation. David, anything to add about that?
Now, I think one quick thought: if you want to time gold, get in and get out, you can make some good money as a speculator. If you hold gold over the long term, I think you'll find that it lags behind other investments you could have made.
Yeah, awesome. All right, now I don't know if we would be talking about this in terms of lagging, but we do have a question on crypto. So is it time to include crypto as an alternative, or is it still too risky? So I have my certificate in blockchain and digital assets. I was one of the first advisors in the country to get that a couple of years ago. And overall, long term, I'm a fan of crypto, and I do believe it's here to stay. I definitely do not believe, and I'm speaking for myself here, and David can comment on his own. I don't believe it's a fad. I don't believe it's just like a pass in the night like scam thing. Obviously, there's meme coins and different things that are for sure. But when we're talking about the primary cryptos, those that are Bitcoin, Ethereum, Cardano, Solana, XRP, those type of cryptos, I do believe that they have staying power, with the most staying power being with Bitcoin, and then increasing risk kind of the smaller you go. And so when we talk about incorporating it into the portfolio potentially, it could be for some investors a good idea to allocate a small portion of their portfolio to crypto. But with crypto, one of the things that you do have to maintain is that it could go down significantly. And we've had in history of Bitcoin, falls of 80%. I don't know exactly how many times, but several times, meaning that you invest, $1,000, you're going to be holding $200. And so if you're okay with that type of volatility, and you're not going to be scared and then say, oh yeah, this was clearly a bad idea, let me sell it off. And you instead say, that's the expectation going in. I'm a believer in the long term. I'm going to hold it to the long term. Then I think you could, as an investor, consider holding a small piece, small, 1% to absolute maximum in a diversified portfolio of 5%, in some type of cryptocurrencies or crypto type stocks. That would be my recommendation. But some people could be zero, especially for those that don't want to take that additional risk. But I would put it in this final perspective, and I'll throw it over to David. What does a 1% allocation in crypto mean to the downside? What it means to the downside is the worst case scenario. If all of the crypto that you invest in for that 1% of your portfolio goes to zero, your portfolio lost 1%. There's been periods of time where the S&P 500 has been down 1% in a day. So if you're okay with that type of volatility in the S&P 500, then having 1% allocation to crypto in your overall world, you should be able to handle that if you're looking at it comprehensively. If you're just going to look at that position and see it, fluctuating like crazy, then maybe it's not for you. But if you put it in that perspective of your entire portfolio and saying the worst case scenario is I lose 1% of my portfolio, that's actually not that bad of a situation. But then on the flip side, you say, what's on the upside trajectory? Because typically speaking, when you hold an asset class, you have to hold a meaningful portion if it's going to make a difference in your portfolio. So if you just hold, 1 to 2%, what's that going to do? Well, what we've seen it do over the past couple of years, and what, some people say could happen over the next several, is multiplicative returns, meaning that, typically when we're reporting stock market returns, we said 25% increase in the S&P 500 in 2024. Well, Bitcoin practically doubled in 2024. So it was a 2x increase or 100% increase. And so if that happens into the future, year over year over year, and you get where Bitcoin is now at around 100,000, and if it eventually reaches the market cap of gold, that would put it around somewhere between $800,000 and $900,000 a coin. And so an 8 to 9x increase in your investment would be considerable upside in the portfolio that you would notice if it works well, and not that much of a downside if it doesn't work well. So that was a very, very long-winded answer, David. I'm interested in your feelings on that.
So I'm going to go back to the original question: is it time to consider crypto as part of our alternative portfolio? And the answer is perhaps for some people, but definitely not for others. And you have to figure out which camp you're in. There's two things that I always think about when I'm thinking about cryptocurrency, or really any of the other speculative things that might come up. One is, I always advise that you should not invest in anything that you don't understand. So if you can't explain to Justin or myself what cryptocurrency is and why it's going to appreciate, then you probably shouldn't be investing in it, regardless of what you see on the news or what your best friend's neighbor's dog walker has told you about it. The other thing is, we tend to get a lot more questions about Bitcoin and cryptocurrency when Bitcoin's selling at 100,000 a coin than we do when it's selling at $25,000 a coin. And yet, everything I've always been trained is that you should buy when things are low and sell them when they're high. So if you're going to venture into the world of crypto, you got to make sure you have a long-term strategy that recognizes that you want to buy when it's low and sell when it's high, and not the opposite.
Yep. And by the way, that it ties into the presentation that we just had, because that's what you do with rebalancing. And so if you do have a percentage allocation, let's just say 1% to crypto in your portfolio, and it does fall and gets cut in half, now it's only a 0.5% allocation. You say, well, maybe I'll take something from that was winning and buy into that weakness there. And then it flips up, it does the year that it had now and doubles, and it's back up to 2%. Well, hey, let's trim off a little bit of that and then reinvest it into something else within the portfolio. So you're automatically taking advantage of the price movements via the rebalance, and not letting something continue to grow and grow in your portfolio that will add continual risk into the portfolio. I'm not seeing any. One last question, and then we will take it home here. How long can the deficit continue to rise, or to what level can it rise before our economy collapses because we can't pay our debt, or countries start calling in the debt? China. David, can you what do you think about this one?
Well, all right. So how high can our debt rise? Well, the bottom line is we don't know. We're in uncharted territory already, and it kind of sounds like a cop-out answer, but we can continue to rise our debt because we're still the strongest economic power in the world. If you weren't going to have your currency backed by the US dollar, who would you have it backed by? Do you think China's got a more stable economy than the US? Perhaps you like the Eurozone. I don't. So could we take on more debt? Can we have a bigger deficit? Yeah, we probably can. Unfortunately, the way you find out it's too large is when things start spiraling out of control. And that is the problem. So I don't know the answer to your question. I just know that as bad as we are, we're probably better than everybody else.
Yeah, I think that is a good way to put it, for sure. And really the amount, because the amounts can be crazy and overwhelming. We can't even comprehend the amounts of like $36 trillion worth of debt and all of those things. Like, just our minds can't hold that. But what really we can look at is the interest on that debt. the servicing of that debt relative to our other expenses. And you saw in that previous slide of the federal, where the federal funds in the budget, that bottom line there was the interest payments on the debt. And so relatively speaking, that was a, not an insignificant amount, but not one of the major amounts. Now, over time, as our debt continues to rise, interest rates, which are play into this, stay elevated, that interest piece will continue to rise. And if that starts to rise and push out dollars that we could spend on something else where we just have to service interest, that's where the spiral would start to continue there at that point in time. So, and nobody knows, no economist can agree on when that point particularly is. And so we're just taking a wait and see approach, it looks like, here within the US, and say, let's enjoy it while we can.
Hey, there's been economists who have argued that deficits don't matter.
That is true too.
Hopefully they're not managing their household budget.
Yes, I think it's in the context of nations where deficits are. I don't think that's on the personal level. That might be an interesting theory they can test out. It will not be me. No, thank you, David. Thank you, everyone, for attending. We hope you enjoyed this 2025 market insights and how you can build a resilient portfolio coming into this year, but also over the long term. If you have any questions, follow up with myself, David. Our phone number 609-586-9308, and our website www.personalwealthstrategies.com. If you're watching this in the replay, all of that can be found down in the description section below. Thanks so much, and enjoy the rest of your Wednesday. Happy New Year.